Welcome back to Higher Exchanges, the #1 independent cannabis investing show, where we break down complex cannabis markets into clear insights you can actually use. Here are your hosts, Jesse Redmond and Morgan Paxhia.
What's up, guys? We are back. Welcome back indeed. I am Jesse Redmond, Chief Strategy and Investor Relations Officer at Leaf Brands. And I'm so fortunate to be back with the smartest cannabis investor I know. He is the very tan Morgan Paxhia. Morgan, it's been weeks since we've had a public conversation. How are you?
It has been. I've been well, but it's good to be back on. And we got a jam-packed fall coming up too, which is great. But I'm glad we got Scott on here for this. These last little bits of summer we're all trying to squeeze out. So,
yeah, we had a quiet August, guys. Quiet August in the industry. We had a little bit of vacation, scheduling issues. So we just hit one show in August. But fear not, we're coming back 3 strong in September. So a bunch more content coming your way. Super fired up for today's show. I love all of them, but the ones I love the most are just a kickback conversation with friends trying to figure out what's going on in the cannabis industry. And no one better than that than Scott Grossman. Scott, welcome back. How are you, man?
Hey, gentlemen. How you doing? How's everything going?
I feel like we're doing well. How have you been? I know you had an interesting summer. I've been reading your Sunday sesh and hearing about Costa Rica, surfing, beginner's mindset. Sounds like you've been doing some stuff.
Yeah, it's been great. Just got back into town after a long respite. And yeah, what can I say? It was just a wonderful summer and just super grateful and ready to get, kicked back into Q4.
And Scott, before I forget, you're a great follow on X SRG144. I think I got that right. And tell people quickly, Scott. Oh, sorry, SRG444. And hit us quick with what the Sunday sesh is and how you can subscribe there, because that's something I always enjoy getting in my inbox.
I appreciate that. Yeah, I started Sunday sesh really for myself. I've been, as you guys know, an investor and now operator for almost 3 decades now. And Sunday sesh was just a way for me to take everything in my brain and dump it on paper. And I would say 80% of it is cannabis through the eyes of a consumer investor, and 20% of it is just trying to understand this unbelievable amount of change that we're dealing through. And so I would say there's a little bit of everything in there. If you're an investor, you'll understand where I'm focused. If you're a cannabis investor and operator, I talk a number about what's going on in the industry, some of the horses that I'm paying close attention to. And if you're just an operator or just someone trying to get through, I just try and figure out ways to connect with my audience on just techniques, practices that have helped me, and hopefully I can pass it on to the younger generation.
Cool. Do you find that substack.com/Sunday sesh, or what's the best place to track that down?
You could just search Sunday sesh or Scott Grossman. Hopefully it's pretty easy. I'm happy to put it in the show notes.
Yeah, we will do that for sure. Thank you. And so much to discuss. Scott, the theme today is Cannabis 3.0. But before we get some momentum on that, Morgan, I want you to hit me with the Flowhub read. And this one, to me, is very exciting. Go for it.
all right. So Flowhub text-to-order AI gives customers a conversational way to shop through iMessage and RCS, which is Rich Communication Services. They can ask what's available, get product recommendations, build a cart, and complete their order the same way they already text their friends. The experience is powered by AI and grounded in live Flowhub data, so every recommendation reflects what you actually have in stock. Once the customer is ready, text to order builds the cart and places the order for your team to fulfill. This is super cool. I have to say I got to try it before it went live, and it does exactly what I just read. It's super cool. And it'll even give you like a little, hey, you bought this last time, and you can just say same thing, or you want to try this, this would go well with this cart. AI is, they're doing a great job with it. So I check it out at flowhub.com. I think if you go to the tools page, and you can get into it from there. Very cool.
Awesome. Thank you to Flowhub for continuing to support the show. And Scott, last time you joined us in December, you talked about the beginning of Cannabis 3.0. You now describe the next phase as being about architecture. Can you give me some idea, maybe remind the audience, start with what is Cannabis 3.0, and then go into what the architecture of that means?
Yeah, absolutely. So you're right. Last time I was on was with Hirsch in December, and I think we were reacting in real time to the Schedule 3 news. I think it probably makes sense to go one step before you had me on effectively a year ago, where I was going through 2.0. And the crux of 2.0, which was pretty variant then, I think it's pretty consensus now, was this theme of bifurcation, where the strong get stronger and the potential winners would lean on their balance sheets and operations instead of hoping for future regulation. I mentioned in December that I felt then that we were on the crux of this new phase, which is 3.0, and I officially called it on the Sunday Sesh in April. And, it's very important not to lose track of my prior themes, which is kind of like how I do in terms of the rolling narrative. And if you remember when we talked certainly in July and then again in December, I talked about this theme of where cannabis stages will stack, meaning 3.0 is building on 2.0. Whereas 2.0 is based on bifurcation and 1.0 is based on the state-led green wave. I felt very strong, and I feel very strongly that 3.0 is going to be all about architecture. And I don't want to overcomplicate it, but architecture to me is really how are these teams proactively building their company for the future? And it's important to, based on what I mentioned about stacking, you're never starting from scratch, meaning, 3.0 is going to be constrained by what you did in 2.0, right? What is the state of your balance sheet? What is your corporate strategy? What does the team look like? Where did you choose to make bets during a time where capital became extremely, extremely scarce? And so the analogy that I like to give people is, think about owning a house after a hurricane, right? You don't get to start with a blank sheet of paper as much as we like to, right? You inherit the foundation, you inherit the frame and the damage and the mistakes and the lessons that are learned. And so I think cannabis companies are in the exact same companies, in this exact same position, whereas the potential bifurcated winners that have gotten through this storm are building off of what's survived. And because of that, I think in 3.0, and we're already starting to see it, is that you're going to see very firm, specific strategies and architectures start to emerge. Different starting points, different constraints, different strategies, and therefore different architectures.
And so unpack what architecture means for me in more detail, Scott. Maybe give me a couple of different examples.
Sure. At the heart of architecture comes down to capital allocation. I know Jesse and Morgan, you're more on the private side, but one of my biggest pet peeves of being a public investor is listening to a CEO talk about capital allocation. You typically hear things about your hurdle rate and a balanced approach, and that always made my skin crawl. And because I have a very different and variant perspective on capital allocation, and I think it comes down to three things, which helps support what the architecture is. Number one is intellectual capital in terms of capital allocation. Intellectual capital is, what is the playbook? What is the strategy? What is the team? What are the operations needed to actually pull off a variant perspective that is durable? The second part of capital allocation to me is the financial capital. It's not only M&A and buybacks, but it's also, where are you putting your capital to work? What investments have you made? Is it CapEx? Is it advertising? Is it buying customers? All of these kind of fit into that financial capital allocation. And then the most important thing is human capital. At the end of the day, you need to attract, train, retain, and incentivize a world-class team to actually pull off those prior parts of capital allocation. The best companies, and since we're talking about cannabis, the best companies have to seamlessly juggle all three at the same time. And what I found over my career is that where companies get into trouble is that they're loose or very poor at one or multiple parts of that critical function of an executive. In terms of what we're seeing in cannabis, I think we're probably going to get to examples. But since the start of the year, I think we've undoubtedly seen various approaches in order to that give you an inkling of what each architecture is. Let me give you a few examples. Trueleaf, carving off harvest to lean into medical, stressing Georgia and Texas, that allowed them to uplist onto the New York Stock Exchange, the first one. They clearly were in the room with the administration when they were drafting the new Schedule 3. They clearly were in the room when they were drafting what Hemp 2.0 will look like, in my judgment. That's one example. Another example is what Boris at Curaleaf is doing, leaning into international. 15% of his revenue now is outside of the United States. We just saw him go for, the first hostile takeover in nearly a decade, going for Aurora. Another example of architecture would be Green Thumb. They clearly are leaning into domestic. They're clearly leaning into brands and customer loyalty. And we saw them go with Rhythm. Now that it's consolidated, they have a valuable currency and a Texas hedge for what Hemp 2.0 looks like. And so what's interesting about today versus where we were, call it 6 months ago, and certainly where we were 2 years ago, it felt very much then that everyone was kind of rushing to fix exactly the same strategy, which was this land grab based on limited licenses. And now I think we're starting to see various strategies start to emerge that when you put it next to each other look very, very different.
Can I add another one to that, Scott? You can tell me if I'm tracking your thoughts here. I think there's a super interesting, this is a self-serving comment, but it's also just a very honest comment, guys, that there's a whole other category of things going on in California. Our CEO, Micah, always says California is a bloody knife fight where, guys are stabbed out, bleeding on the ground. This guy dies, this guy makes it. I would argue a couple of years ago, Leaf was stabbed and bleeding on the ground because we were sourcing material from other farms, running mid-20s gross margins. Now, Scott, architecture, built Salisbury Canyon Ranch, one of the largest cultivation sites in America. Now we're back to a healthy cannabis company that can push 50% gross margins and spit out cash. Leaf is not the only example of that in California, of the survivors. Later in the conversation, we're going to get to Glass House, also super powerful brands in California. I bring this up in the construct of California has been so hard for so long, but there's an architecture there where if you are a survivor and you are the Glass House, the Leaf, the strong California brands, there's an opportunity for cannabis, I don't know what 4.0, 5.0, where all of a sudden everything you've done painfully on this side that caused you almost to die and bleed on the ground becomes super rewarding in that new architecture. Is that an additional framework that you would fall into this 3.0 type thinking?
100%. And apologies for leaving you off, but that is a perfect example. We didn't mention Vireo. They've now are on their 12th acquisition in 18 months. There are number after number, and I think as we get into 3.0, the company story and therefore hopefully the company execution will start to reflect these various strategies that I think is going to be critical as the industry continues to specialize.
And another oh, sorry, Morgan, go ahead, Bloody.
Yeah, well, how, looking at the transition from 2.0 to 3.0, have you give a grading system of how they did it through that environment and how they are, to your point about the bifurcation is happening, but is there have you done a scoring system? Because I think about it from one of your points about capital allocation and human capital, and are you suggesting that some of these companies might need leadership changes because it's largely the same people that are doing the same thing, right? Same roles. Obviously, some roles have changed a little bit, but still largely the same leadership in most of these public companies that we talk about.
Yeah, I mean, I think it's some art, some science. In terms of grading, I think I've been very transparent on which companies I feel have done the best job either getting through the storm or now being in the position, like Jesse just mentioned, to actually capitalize on some of this regulatory change. If I could take a little bit of a sidestep, which I think will make sense and hopefully answer your question. Emerging markets, especially like cannabis, and it could be AI, it could be digitalization of content back 15 years ago, it could be fracking in 2015. All these emerging industries come down to trying to solve for uncertainty, right? There are a number of outcomes and a number of probabilities that could occur inside of cannabis. And the hardest part, and I think where investors get tripped up, is I think Schedule 3 is going to pass, or I think the hemp ban is going to go away or stay here. And in my judgment, I don't necessarily think that it makes a ton of sense to try and peg exactly when change is going to happen, but rather be in a company that's led by great leadership, that has the staying power and the duration. We talked about duration a lot over the years, us three together, that has a chance to actually come out the other side. And so it's very hard for me to tell you what a Glass House or what a Leaf Brands or what a Rhythm is going to look like 6 or 2 years down the road. But at least that they're trying to put the uncertainty to the side piece by piece. And as an investor and an operator, I think that's critically important in this phase of cannabis. I don't know if that answers your question directly, but that's kind of how I think about it.
Yeah, no, it does. And, I think, it's interesting because when you talk about like the horses tied into exactly what you're talking about, is just the value of the jockeys, right? And the jockeys are not just leadership, it's also the boards of these companies and, the jobs that they have to really help make sure that these things are, being done. And so I was just generally curious because I think there still is, and I'm sure when you're saying like it's not like these are set phases, right? Because like 2.0, we are still very much in 2.0, but we are emerging with 3.0 as another layer of 2.0, right? Where it's like, it's not one stage then the next. It's like they build on each other.
Absolutely. Capital stages stack. In terms of the team, listen, I think the ones that we would classify as the quote bifurcated winners, to your point, I forget if it was Morgan or Jesse who pointed out, the teams are largely untouched. Now, I think going deeper, in my judgment, there's been a ton of turnover. And I would just make a comment that if you got into cannabis, Morgan, I'm looking at you, Jesse, you too. You guys have been around almost a decade plus. Morgan, more, right? I think you launched the fund in 2014, if I'm not mistaken. All I would say is like I think we are now at the point where the money grab has been put aside, and so the ones who are left in the industry have a deep expertise combined with a deep passion to seeing this industry survive and prosper. And what I can take from that, again, based on my experience, is if you don't have the talent or if you don't have the passion, I think you're going to get run over because it's not rewarding enough. And there's someone who's going to work harder because he or she just absolutely loves it and absolutely has the skills and so to go back to your question about the team, I think that what you're seeing is you're not seeing a ton of turnover at the top, but at the mid and the lower tiers, you're seeing a ton of turnover. And part of our job as investors is trying to understand why that is. And that's where I spend a ton of time on personally.
Do you know the name D.E. Shaw, Scott?
Absolutely.
Right.
When I was at Magnetar, they were
Oh, forgot you were there. Of course,
we partnered on a lot.
Yeah, Magnetar, I love those guys too. So D. Shaw, for people who don't know, one of the top quant firms in the world. Interestingly, right, Jeff Bezos came out of there, which is kind of a fascinating story. He left D. Shaw to start Amazon in the 90s. Back in my hedge fund days, we had money with D. Shaw, so I'd meet with them on a regular basis, and they weren't very open about their models. So it's kind of like Cannabis, especially GTI, where they didn't share a heck of a lot about what they did, but they kind of like GTI, they put up the numbers to justify it, so they didn't have to share all their secrets. So I'm sitting there meeting with the team, and I said, well, how am I supposed to understand what you guys are up to if I can't analyze some of the quantitative characteristics of the models? And they looked at me and said, Jesse, I could hand you open source on the models, but at the end of the day, trust me, this is a people bet. Even though these are quantitative strategies, they're going to get updated, they're going to change, they're going to evolve. You want to focus on the people that built them and the team around them rather than what's in each Excel spreadsheet. And I kind of thought that, but then I'm like, man, now I really think that. And I've carried that with me in life, that ultimately life is a people bet on things. Like think about your marriage, right? Think about your friendships. Think about who you choose to do the podcast with. There's all sorts of decisions that we make. And guys, it's a freaking people bet. And cannabis, to a large extent, is a people bet. Like nobody, I don't think, has the architecture today where someone can't ruin it. And what I mean by that, somebody could have a great footprint today, plenty of opportunities to mess that up. We've seen that over the last 5 years. Look at, I don't want to be mean. Yeah, I mean, cannabis sure had an interesting business at one point, right? And there's others out there as well. And so I just want to emphasize, and Morgan, Scott, I want to move on to the next section because I could talk for 2 hours here, but I do want to like sometimes on this podcast, like try to say something that's like fundamentally something I believe in my core that they can help people. And I think at the end of this day, this business is a people bet. If you look at Leaf's assets, you find the ranch interesting, interstate export, any of that stuff interesting. I encourage you to get to know Micah really well, because Micah's the visionary that came up with that. He's the guy guiding it forward. Same thing, Jason Terrasant, Boris Curaleaf, Kyle and Graham at Glasshouse, go down the list. But I'll just take a bit of feedback and move on. But guys, it's a people bet.
Yeah, Morgan, I'll take a stab at this. I'll just, full humility, every single bad investment that I've made has come down to execution and people. Obviously, I think of like, luck is the residue of design. But at the end of the day, you want to back in my judgment, founder-led companies that are incentivized and aligned and have a very high ability to adapt. It's not so much intelligence. It's not so much how you interact with people. It's your ability to kind of react to what's going on the field. And, for my judgment, I think that's everything.
I mean, I agree. It's people are paramount. I mean, to your point, every loss we've had has been around people, and just whether they were just not right for the job or had misaligned intentions that were discovered after the fact. Unfortunately, that's pretty common in this industry. And the idea around founder-led that's great but there are very few founders that fit that niche, and those are great and those are special. You certainly can bring in professionally managed teams that can do very well, because a lot of this stuff is blocking and tackling, strong operations, strong financial controls, and but not losing maybe that original kind of energy, that brand, that approach, and fostering that, but being a better shepherd. So because we've certainly had to do that quite a bit in this space, is bring in professionally managed teams. And Scott, to your point, is like, especially in that mid layer, there can be, those folks can be just absolute critical to the company's success. And they don't get the notoriety, they don't get to come on podcasts. They're the people on the field every day, moving the ball down the field, and it's just, and those people are very hard to find. I still think we are in a major deficit in our industry for people. It's and I don't know what's going to change, when that's going to change. Obviously capital flows, higher stock prices, more M&A, more liquidity, that'll bring more talent to the space. But, that's something that, to your point on the 2.0, 3.0 is like, when do we start to get more professionalization? And just as a sidebar, like I was doing a bunch of research on one of these legacy states, and it's like, it's the same people They're just kind of flopping between organizations. And so it's just kind of status quo. And it's like that, you kind of need like a wholesale reset of talent to really change how some of these markets, these legacy state markets, function, and for the better, because otherwise it's just the same folks. So, but anyway, but this actually is a great segue, because we are starting to see some differentiation as we're talking about, and I think it's really interesting because I still do track all these public companies, but they're starting to look so different. Mm-hmm. So it's like, how, we have an ETF that has most of these companies in it, but to call them one, it's not really like, just coming straight out, like MSOS, like to your point, like Curaleaf is not a multi-state operator anymore. They're they're an international company, yet they're one of the largest positions in it. And then you got the differentiation with Trulieve, what they're doing, focusing on their medical business. You've got GTI, as you were mentioning, just there's a lot of differentiation happening, which is really interesting, but it also makes it really hard when you're trying to look at it from like an analyst perspective, like it's not apples to apples at all. Growth rates look different, margins look different. But sorry, go jump in on this, Scott.
No, I think you're hitting on a really critical point that hopefully gets across. Last time, or numerous times I was on, we were talking about the MSOS and how there was only the size of a thimble for investors to come in and out. And we also just mentioned about this differing approaches to architecture. And what's most interesting to me is I made a call in the beginning of the year that I thought 2026 would be a very, bifurcated is the wrong word, disperse. I thought we were going to have a ton of dispersion. And so just looking at the MSOS, it's basically flat over the last 52 weeks and year to date. But look at the dispersion. Trulieve is up 32% year to date, up 30% in the last year. Curaleaf's up 25% year to date, and it's flat over the last year. Glasshouse up 12%. But then there are folks like Cresco down 40%, down 48% in the last year. Ascend is down 40%. So if you would have told me 2 years ago that the MSOS was flat, I think we would probably all say, plus or minus the GTIs, the Trulies, the Curaleafs would probably be in a band, but we're starting to see major dispersion. The second point I would make is the ETF largely hasn't really changed. The composition of the ETF really hasn't changed, but yet we've seen uplisting from Trulieve, we've seen uplisting from Glass, we've seen reverse splits from Curaleaf, we've seen a reverse split from Vireo. We saw a consolidation of Rhythm inside GTI. And so that begs the question. I don't have the answer, but it certainly makes me ask quite like, who is buying these names? I think what we can say with reasonable conviction is that the days of entering and exiting through the MSOS are largely over. And I think that's a really great thing. I don't wish any ill will on the MSOS. I think there's a purpose to that product. I think it's a way for investors to get exposure to the best run companies in the world. However, if you are a real money manager and you have a differentiated opinion, the market is starting to reward that dispersion in architecture and reflect it in stock prices. And I think that's exactly what you want to see, certainly in 2026.
Yeah, and I do wonder because there's so much assets in that product. Is it a hedging tool mostly for some of these shops that are taking underlyings and they are using that as more of a tool versus an investment product? And how does that, interact with the underlyings? And we'll have to see when, like GTI, I don't know what their process is for a listing. We know Ascend is working on a similar strategy to what Trulieve did, and we'll have to see how these things, to your point, is and these are just mostly on the stock side, because outside of Glasshouse, I think Glasshouse is the only one with an ATM active, right? So to your point, from back to kind of bringing this into capital allocation and thinking about how these companies are going about these differing strategies, one thing I've been waiting to see is how some of these companies are going to start resolving some of the 2.0 stuff, which is their balance sheet. Most are not great shape, right? To your point, I think it's a great analogy of saying that's like going through a hurricane and, they still got water damage. They've, the roof is still falling off. Like there's real capital to come in to shore up the, maybe the foundation might still be okay, but there's a lot of money that needs to come in to really repair these balance sheets and set them up for, more success in this 3.0. But how do you think these companies, or am I being too much of a bear after being in this industry for so long to be critical on these balance sheets?
No, I think inside cannabis, I think that's the right question. I think if you kind of take a step back and look at broadly the consumer or healthcare or alcohol, they're levered, right? And the UTP is a whole conversation which we've kicked around in the past. We clearly have to get some
and we should kick
resolution
around
on that.
again because, to ignore the UTP thing is insane. You've got $2 billion of UTPs across the top 5 companies. Was it Trulieve 598 or 698? And Scott, I very much apologize for interrupting you, but I think like the UTP thing is absolutely has to be addressed because what's the resolution? Like there's all this industry buzz about going back to 2023. And if that happens, that's a completely different picture than if we don't even get adult use in 2026. So we're into 27 and we carry 23, 24, 25, and 26, you actually have to pay that money back. And to what degree do you have to pay that money back? And so I think that, you've got to add that to the debt, first of all. And I think you've got to assume the worst case. You can't assume the best case because if you assume the best case, the worst case happens, your whole model, you might as well go throw the thing in the trash. So I think like as that part of the conversation, Morgan, about balance sheets, yes, but balance sheets and especially this notion of UTP, where the balance sheet, if it's 12% debt that's due in 2030, you can model what that looks like. On the UTP, you could have $400, $500, $600 million that you don't know that number is going to go in half, go down 90%, or stay the exact same, and you don't and you start modeling out interest rates and cash flows on that. Some of these businesses are completely drowned if that happens. And if you get the relief, some of them are completely on fire. And so I just want to build that into the conversation because I think that like we always talk about clarity on Schedule 3. Fantastic. Give me clarity on the UTPs. I'd be even more interested.
Yeah. So as a public investor, I think the most important part of what we've learned, really since December, again, assuming it gets through and there's no stay and we don't go off the rails, is the UTP balance should not be growing. And obviously being a public investor, I think the incremental or the second derivative is always more important than actually what's happening. And so I think that's what people are reacting to. I also want to mention, again, we talked about this in July. Remember Trulieve, when they refinanced their debt, they effectively cut their debt in half, right? They could have, my guess is they probably could have refinanced the entire, note that was coming due, but they chose to actually downsize. And so if I look at the top 3 names, GTI, I think it's a question of how much they're going to get back. I don't think they have a UTP major issue. I think Curaleaf clearly potentially has an issue, but I think the Aurora deal is in some way, shape, or form addressing that because it's a deleveraging type of transaction. And with Trulieve, they have an unbelievably cash-rich balance sheet. And the UTP should scare you if you're a Trulieve investor. But I think the point is that it's probably not growing. And so while you should no doubt put that as debt, I don't think it's going to be more onerous than the worst case scenario. I think it's a tail event. Again, we're trying to solve uncertainty, not really price risk. And if you want to go into what I mean by that in detail, I'm happy to do that. But we just don't know. And so I think it has to be in the realm of possibility. But part of the reason why these names are here and trading at the multiples that they are is because that scenario is clearly a possibility. And so as we continue to resolve some of this and get more certainty, I think that will start to be reflected in the equity values of these companies, which in my judgment are still very cheap.
What happens with when companies that are doing this, like Truliev's done it, Glass House has done it, Ascend is working on it, where they siphon off or partition off? Well, in Glass House, they kind of restructure it with Vireo, but for these others where they kind of contain via equity method, right? The adult use business. But what happens to the balance sheet when they do that? And the UTP associated. Do you know? Because like I saw some of these UTP balances went down meaningfully, and I was like, it just doesn't go away. Where did it go? And so do you know how that's being addressed?
I think every company is taking a different approach. I think the cleanest example is probably Trulieve when they carved off, the harvest and the rec assets. The short answer is I don't know. I think the punchline is I think the carving off was done to solve a different problem. I think last time we talked about solutions-oriented equity, right? They truly, going back to that example, they carved off harvest for what, $15 million. So when I talk about solutions-oriented capital, that's exactly what I mean, right? So she was able to carve off an asset for $15 million and created hundreds of millions of dollars, hundreds of billions of dollars of equity value by virtue of uplisting. And so I don't necessarily think the UTP is solved. I also don't think that these carving off of the rec assets is probably permanent. But I think if you're trying to adapt to what's what the game is today, that's kind of how I think about it. I think it's a path, not the destination.
Yeah. So one last for me, and I really want to get into this Curaleaf Aurora thing, but just to kind of wrap up this section, I think is really interesting is it seems like companies are starting to try to differentiate trying to differentiate their strategy. How do you look at it from who's actually differentiating it versus who's talking about differentiating?
Yeah, I think follow the capital. That's really it. Tell me what you believe, that's fine. I think companies are doing a better job telling the story. Jesse, I think you've done a marvelous job on Leaf, going to the farm, showing people the assets, being very crystal clear on what the New York strategy is or is not, raising capital, not to pick on you, but I think it's worth mentioning. I think Glass House is doing a really good job of trying to paint a picture of not necessarily interstate, but potentially intercountry. That was their first sale outside of California, which I think is really important. I'm sure we'll get to it at the end. But at the end of the day, Morgan, it's show me where you've spent the money, what you're actually doing. So going back to capital allocation, at the end of the day, it's got to come through in the numbers. So if you say, hey, it's accretive or there are $40 million of synergies, well, you got to show me it. That's kind of like a little bit of a cop-out answer, but that's the only thing that you as a public investor can rely upon, which is, okay, the story's great. Give me a milestone. I'm going to have to keep you accountable. If the goalposts keep moving, then something's gone adrift, right? Not saying that problems or new problems won't arise, but you got to have an explanation as to why. And that's the only way to keep your management teams accountable.
Yeah, and second that with what Jesse's been doing, it's a very differentiated strategy, and they've done a great job of making it known. Where I think a lot of these other teams are, I don't know if they're just tired or what, but you just you don't hear a peep from most about what's actually going on out there, and whether they have not actually figured out what their actual path is with what they have, or I don't know, but yeah, so I would agree with that.
Yeah, I think it goes to, there's two parts to it, Scott, that you kind of hit on, which you have to show people the story, and, credit to Graham in the early days of Glass House. Like, he was out there kind of like me, in the farm, showing people stuff, showing the expansion, but then you have to deliver on it, right? You've got to light up that new greenhouse. You've got to get that new field planted, harvested, and make the concentrates. And so, yeah, I think you have to tell the story, but then you've also got to very much like validate, okay, what that guy said actually happened. And so I think there's like two pieces to me very much on the IR side of it. But yeah, man, jumping into Curaleaf, fascinating stuff here, and fits in really well with the architecture conversation, because as I spend more time at Leaf, we're working on an export strategy. We're kicking off our GMP certification process for our lab next week, which is exciting. Something I've been spending a lot of time learning about the different GMP certifications, implications of going to different countries, target market analysis, and kind of trying to understand, what does the rest of the world look like? I didn't think that 24 different adult use states were confusing enough, so I thought I'd look at a dozen different countries and really get my head spinning. And it does get your head spinning, because the value of this international supply chain, I think, it's getting increasingly important as these markets open, and there's different keys out there that open up different doors, and that's through these facilities, GMP certifications, and then depending on what business you're in, if you're in flower, concentrates, your vape brand, your edibles brand, your a pre-roll brand, whatever. Certain markets may be like, hell yeah, like Germany loves flower, but for example, edibles, your chocolate edibles are not a thing in Germany. And so a bit of a long-winded intro, but I say it all in the notion of like this concept of architecture is getting more important. And I think that's super relevant, Scott, to why Curaleaf is so interested in what's going on at Aurora.
Yeah, I think it's one of the most interesting events in our space. And again, I said it earlier, it's the first hostile situation in almost a decade. With Aurora, but I'll do a shameless plug. I just actually did a Sunday sesh on this very topic, and most of it's free. So please check it out. I won't have the time to actually go through it, but it makes a lot of sense. I mentioned at the outset that international is now 15% of Curaleaf's business. It's growing much faster in the mid-teens relative to the core U.S. operation. Importantly, it's the largest MSO with the only foothold in Europe in multiple countries with assets on the ground. And I think what we can take from this is that he just needs more verticality, but also compliant cannabis to actually run through his European operations. And, for a variety of reasons, I think it makes a lot of sense in terms of like the financial implications. Curaleaf, no surprise, is trading at, call it 12 times relative to the space at, call it 4 to 6 times for a very similar footprint. And he's trying to buy an asset that has $40 million of synergies. So on a pro forma basis, he's paying anywhere from, call it 2 to 4 times. He's getting access to 50,000 tons of GMP certified weed in Canada that's actually moving to Europe today. He's buying an asset that's down 65% in the last 2 years, despite a real turning of the shift up at Aurora since 2023 that's not getting credit in the public markets. And potentially, as importantly, Aurora has a substantial cash balance. And so Curaleaf is effectively delevering by virtue of the terms that were offered, while getting access to growth and getting assets and having the supply to continue to push Curaleaf well over 20% of international mix, which is a critical inflection point for that business.
Yeah, and I've been. That's a great Sunday sesh, by the way, for anyone that wants to check it out. I love the balance sheet look you did, the synergy analysis, like that. It was a really nice, clean way of looking at it. Because when I first saw this too, I thought, if I were to rank order the intention behind it, I'd put balance sheet as number one. I was like, but seeing that it was structured as stock and cash, it made me think about it for a little bit longer. I was like, was this because it was just kind of like, let's see, can we get this deal done at this price potentially in this way we've structured it? Or if this invites some others to the table, and it becomes a competitive situation. Like so you don't want to go all the way to your top bid, right? You want to kind of come in there and see how it goes. So I was like, just for the sake of a podcast, speculative conversation, why not bid 20% higher and just do all stock when you have such a huge spread in valuation, and to your point, for the cash benefit?
Yeah. So just to kind of recap what Curaleaf has offered, effectively, 0.34 Curaleaf shares plus 75 cents of cash per share. So to your point, the mix is heavily stock. I think, I don't know how familiar you guys are with Bear Hugs. Bear Hugs is effectively before things get ugly and hostile. I think Boris really wanted to do a partnership deal. I think he sees a Aurora investor base that's tired, a C-suite that's been there for a number of years. The CEO's been there for 5+ years and doing really good work, but not getting rewarded. And so my assumption is that he was giving them an olive branch to participate in the upside of the combined company by giving them currency. Now it's expensive currency, but I think that was probably the initial approach. We don't have a definitive deal. In my judgment, there are a number of issues with the offer terms to Aurora, which is why I think you're seeing some of this hostility, and we can go into why that is. But my assumption is that by offering stock and utilizing the cash on the balance sheet, it's both deleveraging and highly accretive and strategically important. And I think it was a really good starting point. And when he was rebuffed, I think he's taking it to shareholders to say, hey, we want this asset. We're not going to overpay, but you, Aurora shareholders, should take a very hard look at what we're offering you because your board is not engaging.
Morgan, I think you have the most context here. Historically, what's been the problem with Aurora's business?
Before Germany, they were just basically they didn't really have much of a business. It was never like a leading product, a category, or at least I didn't think so. The best thing that they did over the last 5 years, and this generally as a kudos to them, was they used their currency to clean up their balance sheet. And they did, without burning a ton of cash as they were doing it. And then they got this nice tailwind of Germany giving them a place to clear product. But, I don't ever hear people talking about they have, fantastic flower, they're like leading, or they're, it just seems like they had a license and they were producing and were smart enough to capture that, the German market and be able to clear their supply. But so to me, when I think about this situation, it's Curaleaf wants to probably bring in a lot of its capabilities and say, like, you have these assets, but these need to be run better. And I think, Scott, you wrote about this as like because some people were trying to say, like, oh, they look at the quarters are looking great, and it's like they were looking okay, they were looking a little bit better, but they were starting to soften again. And to me, that's saying, okay, if competition's picking up, how do they really stand when there's actual competition?
Yeah, I agree. 2020 or last year, fiscal year was really strong. I think EBITDA, going from memory here, grew, call it 30%. But Q4 was weak, and the implication for this year is that they'll be down. And so I think that goes to the opportunistic nature of this bid. If you remember when Aurora reported Q4 earnings and then Q1, really the Q4 is when the stock really started to struggle. It was down 20% in the weeks following that Q4 report as investors digested the glide path into 2027. To your point, Morgan, I think you're right. I've dealt with Aurora over the years. I've written about Canada. I told investors, I've been pretty adamant that Canada is roughly, I'm curious how you think about this, Morgan, but I always thought Canada was, call it 2 to 3 years ahead of the United States in terms of rationalization and specialization. That market has massively contracted in terms of the number of players. I think the key takeaway for me was that, Canada had these glasshouse style grows that a huge, enormous country, clearly, but the market was effectively the size of California. And so there was nowhere to put all this regulated cannabis, and Europe, whether people foresaw that or not, it was their saving grace at the same time as the market consolidated Organigram, consolidated number of assets. And so there are very few left standing. Going back to what you mentioned in the beginning, Jesse, like this GMP certification is critically important, particularly in Europe. And I don't necessarily see that going away anytime soon. In fact, if you listen to what Boris is saying, and you listen to what Kyle and Graham are saying, and I'm curious what you think, Jesse, is like the regulations are getting harder, not easier. And so if you can get access to these scarce assets, I think it's very critically important to remember that Aurora spent, over $1 billion of CapEx and multiple billions in M&A using stock, but all of that is sunk cost. And so for a Curaleaf or a Glass House or someone else to recreate that footprint, it's not only the time and the capital and the red tape. It's just, it might not be doable. So I think this is I do think this is a win-win for shareholders at the right price.
Yeah, my read, Scott, is I think it could be doable. I think it's getting, Germany in particular, like it's so massively complicated. Even breaking down the different GMPs, even if you get into the EU GMP, who comes over, does your audit, what country they're from, what part of the country they're from, all affects, where you can end up sending your product. So it's really a complicated GMP web out there. My read is it's largely solvable, but solvable at what cost and over what time frame is a different question. EU GMP is typically the most challenging to get. Often can take 1 year plus, sometimes 2 or 3 years, and depending on your facility and what upgrades it needs, you're talking hundreds of thousands, typically well into the millions to meet that standard. And then another unintended consequence, guys, I don't know if you've contemplated on GMP, is that it can increase your production costs as well, depending on what you're doing. And so there's a bunch of nuances around these GMP conversations. In Aurora's case, they have the EU GMP, which is the access, largely to Germany for most folks. And you guys remember, what was it, April of 24, I believe, was when Canada or Germany opened to Canadian imports. And you saw what that did to, flower prices. And I think, Scott, that's been a big buoy to these Canadian operators. If that export option didn't show up, I think many more of them would have drowned, which begs the question about, like, if export opens up in the U.S., what happens to prices in places like California? That's a different conversation to have on a different day, but I think an important corollary that someone like you, Scott, would probably be looking at as well. So I think on the GMP side, it's buildable architecture, a matter of time and cost. They have the EU GMP access. They also have one called TGA GMP. TGA GMP is a standard that gets you access primarily to Australia, but there's also some reciprocity in there to the UK. So they're definitely interested in building out the rails. Think like you need a pathway to get to these countries or keys to the railroad to get into them. And I think that's super valuable. And obviously cost-wise, that has a tremendous amount of value, both in time and dollars. But let's contemplate a second part to this equation. And I want to credit Deepak Anand, who's a fantastic consultant that I've been talking to a bunch about international things. And Deepak has this term, what is your right to win? And it just hit me so hard because he's saying in these conversations, okay, so if you get access to the market, just because you get the keys to the EU GMP, just because you have the keys to get into Germany now, what is your right to win in that market? Do you have better flower? Do you have cooler strains? Do you have a lower price? What makes it so that once you get in there and you spend the millions to open that door, that you're actually going to win? And I think I'm not arguing that I don't know enough, guys, about Aurora or about, how this business would work to really understand if they have that right to win or not. But I think it's a critical question that all of us should be asking ourselves. And as you see more of these press releases coming out with GMPs and GACPs, don't just fall for like, they got the certification, now the millions of dollars come in. Say, awesome, they got the certification, the door opened. Now allow me to look at that marketplace and analyze, because they got entrance to that door, can they actually compete and win? And I think there's a lot of corollaries here in this Curaleaf and Aurora conversation. You want the assets to get the access, but then also investors think about it back in, figure out what is their right to win in that market.
100%, 100%. And no, obviously nuanced, but it's not too dissimilar from getting a license back in 2014, right? Like, okay, you have a license to open up a dispensary and you have to be vertical in Illinois or New Jersey. And, you know, I think we can look back in hindsight and say it wasn't worth much. It was hard to do. It required a lot of work. It required a lot of capital. But the ones who actually did something meaningful with that license built something differentiated. And I think that's a similar analogy. I don't think it's completely apples to apples, but I think there's a lesson there for sure.
Yeah, there's definitely around these licenses. There's definitely a premium around first mover, right? Because especially, you know, if we have time getting into capital allocation, what you actually do with that license to make it productive and valuable, and, you know, building great products and great brand value. But I don't know if you guys have seen what prices are for brand new licenses in Florida. Because, you know, they did that second issuance or whatever, that last batch. Most of them, I think, or all of them, none of them were built. But they are now being actively sold. And we all remember, I'm sure, when Florida was first opening, a license there costs, someone sold a license for $100 million. And guess what today a license goes for? So no debt, no assets, just brand new, just paper. The paper, the ability to go in
5 to 15.
I was going to say 10. I was going to say 10. Yeah.
Saw one come across for 4.
Yeah.
Opening bid. So, and I also say that in the context of, like, Georgia's really hot right now, and those few licensees that are there are now getting what feels like old times kind of valuations all over again. So, but it's because that first mover, because you have the ability to just build out a lot of stores and get a lot of market share. So there's still like, so I wonder how to, and, you know, I know we were talking about international, but because I just don't know enough, but like, how do you assign international, like, these values to the GMP, to your point, Jesse, the rails, like, to be able to get in and be operating and establishing a footprint before more competition comes in? And how do you really, you know, understand what that value is? What do you think, Scott?
I don't have a great answer.
Yeah. I mean, we can kind of compute a little bit around how Curaleaf is looking at Aurora, right?
Yeah, I was just going to say, like, the way I think Curaleaf is looking at it is, I think first and foremost, I think they believe that they will operate it better, right? Boris has talked about the yield difference between their grow and when Aurora is kicking out. Boris has talked about genetics. And so as I think about the multiple that they're paying, combined with the synergies and the cash balance, you can run the numbers, but based on what they basically put out, they basically have to run it efficiently for 2 to 3 years, and they're break even. So I think from their perspective is, oh, and by the way, I missed one critical point, which is this concept of verticality, right? They're already in, Curaleaf is already in Europe, and they're already buying a lot of the biomass from the Auroras of the like. And so just like we think about vertical markets in the United States, there's going to be additional margin opportunity by combining, you know, we always talk about grow co, distribute co, and you know, retail co or brand co. I think there's part of that too. And so I think the cash on cash payback for Curaleaf is pretty attractive. And so while they don't have a crystal ball on how much competition is coming online, who in the United States can get a GMP, how much of new licenses are coming up, I think they have reasonable conviction that regardless of what gets thrown at them, they'll be in a much better position and help leapfrog them for that when the competition does come. They're in a much better position to absorb some of that competitive headwinds. That's just my take.
Yeah. Can we just double click on that with the 2 to 3 year payback? Do you know how that, did you calculate that, or was that?
It's just a kind of thumb in the, I do have a model and I have it in front of me. But if they're doing, call it, they did 40, this is Canadian, but with the synergies, they're probably at $50 million of EBITDA. And so I don't see any meaningful additional CapEx. And so, just based on what they're paying for the business combined with the cash, in terms of what they're actually putting out, I think the math kind of spits out for it. I mean, if you're paying a 3 times multiple for the business, you've got to effectively, you can run in place for a number of years and hopefully get some of that back.
Right. No, I just didn't know if it was off the headline multiple or if you were taking in the synergies and into that as well.
With the synergies.
Yeah. Okay. Because that's an attractive.
The synergies are low.
Okay. Yeah. Right.
I think the synergy, if you go through the numbers on the $40 million synergies first, just based on my past and all of our paths, you're never going to put out the real synergies, particularly when you're in a hostile situation. So my sense is that 40 million is rather conservative. Yeah. And going through that 40, if you start doing the numbers on the actual yield differences between what Curaleaf thinks they can get with Aurora's assets, the synergies start getting pretty wonky pretty fast. That's just kind of my assessment of the situation.
Well, guys, this has been a great conversation on that topic. Morgan, do you want to run through capital allocation a little bit, and we'll see if we have time for any more after that?
Sure. Well, I mean, we were kind of just touching on a little bit here with this Cura, but I guess, when we're looking at the landscape today, we are starting to see some more capital allocation, whether it's tuck-in small store acquisitions, whether, to your point, it's not actual dollars, if it's human capital or intellectual capital. But there's some M&A starting to happen. I mean, obviously Vireo is completely just going bananas and having a field day with M&A and getting a lot of stuff done. But it still looks a lot, we're still kind of emerging into more of this activity, right? And so I guess, just starting off, into thinking about we do still have some of the similar players, but where are companies still destroying capital? Let's start with that one.
Oh, I don't know if I want to, throw anyone under a bus. So I don't know if I have a great answer for you on that, Morgan. I probably want to stay away. I think I'll answer that by saying the horses that are not in my stable, I have questions on. Put it that way. And so that could be because I just don't know, or I haven't done enough work. But those are the situations that I purposely avoided, just because I don't necessarily think I have a great grasp of where they're differentiated and what their path is. And even if they had a strategy, if they had the wherewithal, the talent, the capital, and the right playbook to actually pull it off. I know that's not exactly what you want to hear, but that's how I would answer that question.
Yeah, well, and I think about from the early days when we were trying, a lot of these companies were building and being acquisitive, and there was so much white space. There was not a lot of data. There was not a lot of, we just didn't know how things were going to go. And valuations were a lot higher back then, not just in cannabis, but, in a lot of SaaS, right? I mean, SaaS was trading at these huge multiples. So we saw like SaaS do these crazy deals in our space too. But now we have a lot of data, and we have a lot more maturation of a market. It's still emerging globally, but and there's still plenty more to be done here, but we have a lot more data and understanding. But I guess, so then I guess the question be, how should we be evaluating how M&A looks today, and how would we better grade how companies are doing it to say, yeah, that's a good deal. That makes sense. Is it the payback?
Yeah, I think that's a fair question. I probably, let me give you a real time assessment. I think Vireo is probably the number one situation to evaluate M&A right now. I mean, they're clearly gobbling up a ton of companies across the country. Like I mentioned, I think they're up to 12 now in the last 18 months. I think the difference with Vireo, just as a headliner, is number one, the financial sponsor behind Vireo, in many ways is solving a problem that we've talked about over the last couple of years together, which was effectively equitizing the debt. And so what Vireo seems to be doing is they're buying the companies mostly with currency and rolling the debt into the pro forma newco. And so they're buying assets at much, much lower multiples than when we saw in the first wave of M&A in cannabis. Go back to the Trueleaf harvest. It's a great example. And the multiples that Vireo is paying is wildly lower. In terms of how I would evaluate that situation, in my judgment, it's going to be integration. I think the precedent here, we have a lot of precedent outside of cannabis on roll-ups. I think that's pretty well understood by a number of investors in and outside of cannabis. But I think the precedent is air, right? I mean, they had a great team, but they paid peak multiple on peak EBITDA. And if you go back, and I think everyone probably has their own opinion, but I'll share mine, it just didn't seem like those assets were very well integrated. And so it was a little bit more of a decentralized type of model, at least from the outside looking in. And it seems that's what Vireo is trying to do as well. Sammy's been on a number of podcasts talking about what they're doing, Sammy at C21, as you guys know. And so they are taking that decentralized approach, but the difference is they're just paying a fraction of the multiple and they're not putting any leverage on this business. In terms of knowing if it's going to work, I think at the end of the day, whatever they're buying has to look better tomorrow than today. And that's going to be the yardstick for me, is like, ultimately, I think Sammy talks about, revenue per share accretion. With full respect to Sammy, he's a good friend. I don't look at it that way. I think for me, it would be free cash flow per share, because of the point on trying to figure out what gearing there is on the equity. But I think that's kind of how I would evaluate it. I'll stop there, but that's hopefully a real-time example of how an investor like myself is going to evaluate. I don't have a position in Vireo. I've looked at it. I'm pretty deep in diligence. They're clearly over $1 billion pro forma. They're going to be the largest dispensary owner network in the United States. But it gives me heartburn knowing that this was kind of what Air was trying to do just 5 years later. And so now that I have those two examples, I can compare them and say, okay, what's different? What's not? What did they say they were going to do? Did they deliver? Did they not? And ultimately, what's that worth?
Yeah. Truly impressive what they're doing, the rate they're doing it. And to your point is, like, as we were talking about earlier, is the talent level on all this integration. And, because it's coming fast and furious, and they are not slowing down. I mean, I think we were talking to someone earlier this year, I'm trying to remember which guest it was, and they thought that the Vireo was going to slow down. And I was like, I don't think so. And boy, they've gotten a lot of stuff done, and it'll be interesting to see. To your point is, because Sammy's been talking a lot about, same store sales and revenue per share accretion and all this stuff. And I like the idea of free cash flow because, they're supposedly buying these assets that are already built. And so there's not a lot of CapEx needs, right? So that free cash flow is probably pretty good. I mean, there's going to be some rebranding and probably refreshing of things to get it in line. But they also, at the same time, I say all this, but they also have this model where they want the companies they're buying to stay who they are. So maybe free cash flow is the right thing, because they won't have all this cost of overhauling things, and they're going to just try to be more normalizing on the back end and let the existing footprints run as they were. So it's very interesting, just in the context of it compared to Aurora and Curaleaf.
I completely agree. We talked about the scarcity of capital in this industry for years. And we also talked about the fact that, deals weren't getting done because the bid ask, it wasn't accretive and all that. I don't want to go back in time, but Vireo is demonstrating a clear competitive advantage, right? Like, it is so hard to do one deal, let alone 12. The speed, the complexity, the legal, the operations, the licensing, the transfers, like, this is not easy stuff. And so that, to me, suggests that is their edge. Now, they happen to be in a lot of these capital structures already. And so that bid-ask question kind of goes away, because they're the bid and the ask in some respects. And since they're using currency, they're effectively saying, hey, they're kind of doing what Boris is doing, which is like, do you want to be part of a bigger organization that has a chance to win? Or do you want to just kind of wither away? And because they're on both sides of the capital structure and both sides of the buyer and seller, the friction is less. Yeah. That, to me, going back to where we started on architecture, that to me is their playbook. They've assembled a team that can pull it off, and they have the financial wherewithal to actually execute. That is hopefully that's a good way to illustrate how I'm thinking about 3.0.
Yeah, and the point about timing is so critical, because to your point, when Air was doing it, valuations were so much higher, was so much more costly, was so much more, equity issuance, versus today, where these things are happening at very low prices, and people are also tired. They want to transition. They want to say, yes, this, here we go. Let's be a part of a bigger organization. See if we can have more success doing it with much more scale. Timing is totally different and in their favor. And I do find it interesting, though, when we come across situations where people that are a tiny fraction of the size think they're like, no, we can compete with this, and we're going to turn down this bid because for whatever reason. And I'm just like, I just think there's so many people where it makes a lot more sense to, the current trajectory, to your point, a lot of companies are in the withering trajectory. They are not on the upward slope. And as you said before too about Canada, they already have gone through this rationalization. There still are plenty out there that are trying to fight it back, but Vireo's finding the companies that are like, yep, let's go. And I'm kind of interested that Aurora investors are also potentially fighting back, because this is here's an opportunity. You got a nice bump from where it was. I know it had, it's kind of bounced around, but, reset the table. And if you don't want to be part of the game, you can sell. It's a nice thing about being a public company. You can just sell and move on. But for those that don't, they can bat on and see what can happen on a larger footprint. It's interesting how we have made a lot of progress, but there still are, where these frictions still reside in our space. And, it's how much more withering and tiring do people need before they're going to say, okay, let's do it. But problem is, the longer you wait on that withering vine, it's, deflation is not your friend.
Yeah, good point.
Jesse, do we want to do a quick?
Yeah, let's hit it, man. I think it's an exciting conversation. And a friend over at Glasshouse shot me a message. And just to clarify, they are not using their ATM. If one of us misspoke and said that, I apologize. I don't think we said they were using the ATM.
I just said they had an ATM. You're right.
Okay.
I'm sorry. But I would think with a nice valuation, they could use it. I didn't say, sorry if I didn't mean to say that they were. Sorry.
Yeah.
I don't think they have a need for it, personally.
Yeah. Yeah, and I think you'll see more of them out there, right? I don't think there's something that should always freak people out. They just give people optionality, and I think if we, get some movement here, we'll see more of them. But anyway, just wanted to clarify that about Glasshouse. But Scott, you've been doing a lot of deep work here. Glasshouse kind of fits that California architecture 3.0, winning in California today,
100%.
a lot of opportunities across the U.S., starting to capitalize on overseas opportunities. So why don't you lay it out big picture for me, Scott, where you are in Glasshouse, then maybe we can dig in a little bit more.
Yeah, sure. So full disclosure, I'm an investor in Glasshouse. Do your own work. This is not financial advice, but Glasshouse is one of those names that if you've been around in cannabis for as long as we have, it's like hard to ignore. And I've been watching them since the SPAC days. Never been an investor until last year. I was in the warrants, if you remember. I think we talked about it in July. And then as soon as they refinanced the prefs, I migrated into the equity. I think, what Glasshouse, I think the what they're trying to do makes a ton of sense. And if you think about what we've talked about on previous episodes, and some of it today, is the walls seem to be coming down, right? We can talk about whether it's the Iron Curtain of states, and that's interstate, but also intercountry. And I think Glasshouse's model was predicated on finding highly scarce grandfathered assets, not too dissimilar from your set of assets, Jesse, in terms of actually trying to secure that footprint. And it's the one company that I could think of, other than potentially Leaf, that has this kind of formulaic growth algorithm based on capacity additions that are already basically there. And if you've ever been to the farm, it's like there's nothing you've ever seen before. Up to, call it 6 million square feet. They are the lowest cost producer in the country. They're in the perfect environment, grown from the sun, not reliant on the grid. And I think if you believe in a world where cannabis becomes ubiquitous, and you believe in a world where they can actually move that biomass outside the confined walls of California, which they've already proven, the earnings power of this business is just enormously convex. And I would argue probably the most convex out of all the big, call it tier ones and tier twos. So I find it very interesting. I always talk about like this horse, safety, spits, and stupidity. Glasshouse is, I wouldn't call it the safest of my bets, but if you think of kind of where I believe cannabis will be in 5 to 10 years, there aren't many companies that are well positioned for a world where the United States is dominant in cannabis, and there aren't too many companies that can actually produce cannabis at a price point that is highly competitive to, other than like outdoor grows that are used for a very different form factor. And so I think they've done an unbelievable job getting through this wall of worry. They were rated, as you guys remember. They had a capital structure issue, as you may remember. But since in the last, call it, year, they've hit a number of milestones that they said they would hit. And I think the future for the company is extremely bright.
Yeah, Graham is very operationally gifted. He's one of the people that I really admire in the industry for his intellect and his ability to use technology to improve things. And you can't argue with the success that they've had there. Scott, how do you think about three components to that story? And so again, we have what I call the knife fight in California, which continues to be a challenging market. Feels like it's stabilizing, flower prices peaking up a touch, but still, a difficult market overall. Some of the lowest prices, maybe second lowest prices, maybe the absolute lowest prices in the country. But so much optionality, right? I want you to break that down into two pieces. One is the interstate piece. Obviously, the ability to ship things across the country, potential supply chain agreements there with other operators, potentially powering brands. Glasshouse Brands, already a strong brand, could leverage the CPG aspect there. Allswell, consumer brand, strong in California, could leverage the CPG aspect there. So optionality in terms of what they could do in terms of strategy to go across the U.S. And then, Scott, also that move into Europe. I caught most of their spaces, and it sounds like they're pursuing GACP certification for one of their facilities. and that would potentially open them to partner with others to get into Europe, which is super exciting as well. So talk to me about those three pieces to that architecture.
Yeah, I mean, I think California is no different than a grown rogue in Oregon that's moving east. They're, and I subscribe to it, is like, if you can stay afloat in the hardest markets in the world, and then you can go to other markets, there's something to be said about that. I think it's, of all the public cannabis operators, their disclosures is pretty detailed. And so you can clearly track their cultivation costs over time, and it's only going one way. And I think as they stand up more additional acreage, that will continue to go down. I think they've guided, call it $95 a pound, which if you kind of do the math on that, that's like a 25-cent pre-roll. And so, I think that an investor in Glasshouse today has a clear understanding of where California is today. We've always talked about the number of cultivation licenses coming down. We've talked about the number of brands that are going away. That market, to me, doesn't feel as bad as it was, call it 3 years ago. I have a variant view on pricing, which we talked about in July, and then again in December. It feels firmer, at least heading into Croptober, relative to last year. The dispensary network is tighter, and they've already proven, call it 5 months ago, there were a number of bears on Glasshouse are saying they're never going to be able to move weed outside of California, and they've already done it. Now, it wasn't intoxicating. We don't know what the price was, but they're giving you a vision as to their ability to move some of that biomass outside of California. And because this is such a fixed cost nature business, they're setting up to be, the Chiquita or the Dole, the agricultural giant of the industry that I think has significant moats. I don't necessarily think we're going to see a new grow. Maybe Texas, I have an opinion there. Let's not go there. But I don't think you're going to see a significant amount of new capacity go up in the United States, maybe ever. And going to your second point, I think the economics, I asked Sammy on my Sunday sesh, I think the economics for dispensaries throughout the country who want access to high quality, tested, safe, very affordable cannabis is at an all-time high, especially when you're with electricity and inflation, and the economics just make sense, right? If you're buying wholesale cannabis at $800 to $1,200 a pound, and you could buy direct, there's a huge gap that Glasshouse can slot into. Now, I don't think 100% of an Illinois dispensary or Georgia dispensary is going to be Glasshouse cannabis, but you have to imagine that some portion of the shelf could be diverted to cheaper weed. And I think that's the opportunity. There's about 15,000 dispensaries just in the United States. There are a number of states that are starting now, like Texas. I don't know how well you're following the data center build out in Texas, but they just effectively put in moratorium on ERCOT, which is the regulatory agency that handles the electricity grid in Texas. There's like a 4-year waiting list just to get on the grid. And I just don't see how a cannabis operator is going to front run a data center in Texas. And so if you're sitting there, whether it's Texas or Georgia, I think there are a number of states that would love to have access to California cannabis at very cheap prices. That's the second bucket. And the third bucket, I think, goes back to the Aurora situation. Genetics, California appellation matters, and cost matters, and they're competitive. And so for a Glasshouse investor to win, you don't need 100% of your biomass getting diverted outside California. But if you had a release valve where you could have some of that capacity spoken for, I think that would be wildly accretive to the business that's growing at $95, selling at $225, when the real market is anywhere from, call it $800 to almost $3,000 a pound outside of California.
And Scott, what's your opinion on the interstate opportunity and the time frame under which that happens? Because when I think about the export, my crystal ball is always murky, but my crystal ball gets a little cleaner on the export because I can see the path. I can see this DEA channel opening. I can see matching certifications to countries, export permit, import permit, few more boxes checked. I think that's an achievable thing for companies in 2027. Interstate, my crystal ball gets murkier because the rails really aren't there. You need either work on the dormant commerce clause to have something meaningful across the board happen, or we're going to go state by state and unlock some things, which is going to be a little bit longer path. And so, what are your views there, Scott? Do you agree with me on the international potentially coming first, and how do you view the state by state opening up? Because you can't argue that for a low cost California producer like Glasshouse, that when these markets open, it's going to be a tremendous opportunity to sell more product at higher prices. Does that normalize in a national, cannabis economy? Yes, but I think that takes a fairly long time to happen. So tremendous opportunity, I think, on the interstate part. But I feel like the interstate part is harder to figure out. When does the first one happen, and then what's the order in which the other ones happening? The other ones happen, probably with Florida, maybe at the end, right? One of the biggest states, probably at the end because of the mandatory vertical. But we'll see how it goes.
Yeah. So, I mean, I think the intercountry has already happened. Again, it was CBD, wasn't intoxicating, but I think you're going to see more of that. And it doesn't necessarily have to be one-off. It could be a big something, big tobacco, big alcohol, securing biomass. And that would be probably the near term, is that I think you'll see more international diversion. And whether that's through a GMP network, but I think that's what management team has been pretty clear on. The interstate, I think I don't have an answer. I don't have an answer. There are a number of views, in terms of going medical. There are a number of people who think that if it's just Schedule 3 medical, we talked about in the past, like these state offtake agreements. I think that's probably the more likely scenario, where you have California striking a deal with another state where they can actually move cannabis in a legal fashion for medical only. And that's probably the second example of how you'll see Glasshouse moving cannabis outside California. But again, going back to this concept of uncertainty versus risk, there's one of the beautiful things about Glasshouse is that there's just so many outcomes. And I can't tell you the probability, but the fact that the company has the optionality and it provides an investor just an enormous amount of convexity. If you actually go through the various cases, there's a clear example where the company is making well over $20 per share in gross profit, and the company's valued at $1 billion, call it 100 million shares outstanding. So most of the MSOs today are trading for anywhere from, call it 3 to 5 times gross profit. Now, that's not the best metric, but in Glasshouse's example, that is the metric, because they don't have stores, they really don't have marketing, they really don't have distribution. And so it's really a gross profit type of business. And when you have the programmatic build of the square footage that's going online, and you have the precedent of them actually doing that, the formula becomes so powerful that I just don't think you're paying a lot for that option.
No, they do a nice job on the IR side, making it digestible in terms of like, here's what we're going to turn on, here's what the value of it is, here's the time frame under which it happens, and they've done a nice job of meeting those milestones on the operational side. Scott, let me wrap with this. I think investing, and the older I get, I think life is a risk management business, and you're always thinking about what could go wrong. So when you look at the Glasshouse story, you shared a lot of the potential positives. What keeps you up at night about it? What are the things people should look at and say, what are the things that could go wrong?
I think the biggest risk outside of like fat tails, a fat tail would be getting raided again. Fat tail could be a disease in one of the grows. So putting that aside, I think the biggest risk to the Glass House story is matching capacity with demand. And so there is a scenario where they're turning on lights and grow rooms, but they have a sinkhole in demand, or they grow basically growing too much and not having an outlet. Again, this product expires, right? So whatever you're planting in the ground has to be out the door in, call it 90 days. And so if you sequence that wrong, you're going to have a major hiccup. I think that's the biggest risk and what keeps me up at night. The flip side is also true, by the way, which is you have demand outstripping supply. And that's probably a good problem to have, and hopefully they'll lean on that side. But I think that's probably the biggest risk to the story, which is how do they match capacity relative to the true underlying demand? And once the demand is there, do they have the ability to actually meet it because of regulation, GMP, all that stuff? And I think that's going to be their challenge this year.
Yeah, I think that's all well said. You want to have the capacity for where the demand to serve the demand you believe is going to be there, but you don't want to get ahead of yourselves with the capacity as well. So it's definitely a matching exercise. Well, this has been great, guys. I think this has been overall an awesome conversation. But before we get out of here, I want to say, Morgan, I did love your Flowhub read today. I'm a guy that really likes what's inside the dispensary. I don't always enjoy the process of going in the dispensary. And so the idea of being able to, text, get some recommendations, place an order, have it waiting for you and go in and out, that's the kind of thing that would compel me to say, I'm going to go to that store. How do you get that, guys? If you want to be that store, go to flowhub.com and schedule a demo today. Exciting stuff. I would like to use that texting technology. I'm going to see if that's available in any stores in my area. Scott, great to see you again, man. Welcome back from your summer excursions, and thank you for being here again. Morgan, always good to see you, my friend. It's been too long since we had a public conversation. I think today's show was great. I hope everyone else out there enjoyed it. I always like kicking back and having a casual conversation with you guys. On the podcast side, on the YouTube side, on the social media side, if you guys could do us a solid, if you're on YouTube, thumbs up, subscribe, drop a comment. That's super helpful to the algorithm. If you are on the podcast side, hit like or subscribe. I don't even know what you do on those apps these days. YouTube is the one that's really taken off for us. If you're on the social media side, I think all of us are guilty of this these days. You see somebody's posts, you kind of like it in your head, but you don't actually tell them that you like it. And so I'm trying to get better at that. When I see something you guys like, actually hit that like button and show some love. Appreciate if you guys could do the same. Reposts are the most helpful. So thank you guys all for that. I think we can leave it here. We'll be back in a couple of weeks. We're going to try to hit 3 shows here in September and make up for a soft August. So thanks again, guys, for being here. Thank you all for listening, and we'll see you guys again soon. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor recommendation. All investing involves risk, including the loss of principal.